G'day listeners and welcome to another episode of the Scouting Australia podcast powered by Australian Property Scout Buyers Agency. I'm your host, Sammy Gordon, and today, guys, I've got back in the studio. We're in the Sydney studio today, and the man has copied my exact replica in terms of clothing. I'd like to welcome Mr. Jimmy Ibrahim back in the studio.
G'day, Sammy. G'day, listeners. And g'day, all of our Sydney listeners. We are in your backyard here in good old Alexandria. Lovely area, Sammy.
Mate,
lovely area.
You told me some
spent a
some
bit of
stories-
time here
some
in
stories
my
from back in the
early
day.
days. But it's great to be here. It's a bit of a different studio for all of our YouTube listeners and watchers. You'll be noticing that Sammy is copying exactly what I'm wearing. He can't dress himself. However, I am excited to discuss this topic, Sammy, but I need to address one thing. Why were we in Sydney? Why are we in Sydney? Give the listeners a bit of a sneak
Mate, I
peek.
knew you were going to dive into this to see if you
come
can
on.
roll the waters
Why
up. The
are we in
shallows.
Sydney?
Mate, so we had the REB Awards last night.
Okay.
And, so we were down for the REBs. The Real Estate
Nominated
Business
for?
Awards. Mate, we were nom for 5 awards. We had young Paulie Dem nom for a double. I was nom for a double, finalist.
Yeah.
And Buyers Agency of the Year as well, the big one too. So
5 awards. So
5 awards.
clean sweep, took out the whole 5.
Mate, to say that we were fucking pissed is an understatement. 0 from 5, and just like I don't know what metrics these fucking clowns are running off, but I think they're measuring something else instead of actual competency. So, man, to say we were pissed is an understatement, especially when I know the quality of other blokes even up there as finalists. But yeah, man, it was disappointing, but I think we've had enough of it, and man, I don't think we're going to worry about going back. It's literally like, these guys, how are they even rating it? You know what I mean? How are they grading? How are they selecting these people? Yeah, man, especially when we know quality difference. Like, we negotiate against in the same markets and see what these guys overpay compared to us. So, yeah, man, I don't think we'll worry about wasting our time coming and doing other ones.
Now,
So,
some people would say,
not from like a dummy spit perspective,
I'm just
like
playing
a
the
fucking load of
objective.
shit perspective.
Yeah,
you know?
yeah. I think, awards are nice, but is it fair to say the awards, and not shit canning the actual awards, but that it's debatable as to what they actually mean. But is it more of an ego thing? Because the business has never been in a better space. There's huge
100%.
demand for what we're doing. So does it really matter if you win an award or not?
But I don't think it's so much from an ego. I think it's almost like a, I almost see it as like attributing to the fact of like what we've dedicated ourselves to compared to everyone else, you know, in terms of what we've gone out there to do, retain quality, even though we're growing, retaining quality, like having all that is an absolute paramount of what we do, mate. Like, I feel like so much of that is so important to us. And when you see other people that just don't operate by the same code of ethics or like operate at the same level of intensity and willingness to retain that for clients as well, man, it just pisses me off. So like it was something that I thought would be a good little accolade for the business, and like obviously for
reward, right?
Yeah, for the clients and stuff as well, man. Just a bit of
it.
acknowledgement. But yeah, man, like it's just it's riled me out, bro. I was very angry last night by the end of it, because just to have 0 from 5, like when we're literally the highest performing buyers agency in the country, it just doesn't make sense.
Yeah,
it's like a blue ribbon, bro. It's like, oh, well, who's been here for the most years and hasn't won something? We'll give it to those guys. And it's I don't know, man.
Share it around.
Oh, man,
try and keep people in.
It's like the ribbon at school for participation. Like, everyone gets a trophy, mate. Fuck hell.
The last thing I'd say, if there was ever a guy that didn't need any more motivation to try and prove people wrong.
If they wanted to put a target on everyone's backs in the industry, like, I just want to fucking destroy everyone now. And like, we're already their best, mate. We're like, there's going to be a stratosphere and then all the plebs on the ground. Like, that's the difference in terms of what we're
So you're going to
doing
Mars. You're going to a new planet.
Mate, new planet, new hunting grounds, scouting trip. There's a Scouting Australia jet is coming into a rocket ship.
Now, going away from the REB Awards, and the reason why we wanted to record this particular episode is because the recent, by the time we're recording this or it's actually being played,
Yes.
the previous month,
Well, the interest rates were cut on Tuesday.
Yes.
Like, the interest rate cut came in on Tuesday.
Yeah, we're filming
We're
this-
recording on a Friday. REBs were last night on the Thursday. So it's literally been 4 days post, obviously, interest rate cut.
Yep.
First cut
Yep.
since November 2020, mate. So we're talking like over 4 years since the last cut.
It's crazy.
Wild, man, wild. So I thought it was prudent to kind of go through. It's like, is now the right time to buy? And kind of run through everything around that as well. And should you be waiting? Should you be holding? You know, all these sorts of things as well.
Straight off the top, were you surprised that they cut interest rates?
Man, it's a funny thing because like we're having a chat about it internally in the team, and like all the pundits and all the money markets and all the rest, so they price in like a 92% chance or something like that. And it's funny because Lukey and I were looking at it and we're just like, we both still believe interest rates probably should have held where they were. And neither of us took a bet against each other because we both agreed that we thought it actually was going to be a hold. Man, inflation isn't in target band. Like markets are still pretty bloody tight. Yes, there's a bit of mortgage stress around, but like we were like a little bit worried that it was a bit premature. And like one of the biggest things that Michelle Bullock, the RBA governor, came out and she said was she's like, this thing, if anything, is like it's almost like a recovery of the one that we did in the cautionary one that they did in, I think it was November 2023, where like markets were starting to get away a little bit again. So they're just like, you know what, like we're gonna taper and control that. So they did an extra one when they hadn't done one for ages. It was almost like just to like recompense against that one. Okay. And that's kind of the way she put it, and the fact that more than likely we aren't going to see any again for a while, or it's not going to be as if we're in this huge rate cutting cycle right now. So yeah, man, we didn't think it would be coming in. Again, there's a few things that maybe are outside, our scope of what we were sort of thinking around it as well. But yeah, man, it's not as if it's going to be the big start of a big rate cutting cycle. It's just obviously the other big thing to throw into the equation is like a lot of people on the board for the RBA are Labor backed, right? And Labor wanted that cut. Yep. They needed that cut before the federal election. 100%. So like how much did that have to do with it? Like we honestly believe like a very, very strong factor, because they're trying to generate people's support. Their whole thing when they came into government, we're going to bring rates back down. We're going to see all this stuff. We're going to see affordability increase, cost of living pressures ease. Okay. And it's only gotten worse and worse and worse since they've been in as well. So,
politically motivated, essentially.
Man, I think in a big way, I think there was a lot involved with it. Even again, in the minutes from the RBA meeting, it was very clear that Michelle Bullock again said it was a fierce debate internally as to which way it was going to go, whether it was going to be a hold or a cut. So I think that pressure was probably quite strong from the federal government to see that one come in, and you can see now they're doing a big push for it now to try and build that momentum behind them trying to change to affordable, ease cost of living pressures. Whether it's a little bit too late, I don't know, but it's why they're doing it. Political stunt,
Interesting to see that politics are at play at the RBA and the REB awards last night. So politics can't get away from the politics, have you?
Yeah. I think Labor might have, it was a Labor decision, I think, on who picked it. It was. I won't go into
now, question for you then, right? Okay, so interest rates have been cut a little bit. Is this cut enough to do anything to the market or to house prices? Like maybe it's because people haven't seen a cut for a while that people are getting a bit excited. Take it easy. Or should they get excited?
Mate, I think there's two things here. The one thing to get excited about is it brings an end to the rate rising cycle. So the increasing cycle, right? So we are at a point now where we probably are going to see, we've moved into the rate cutting cycle, which is something to be excited about and something to be happy about. We're probably not going to see that increase, again, definitely anytime soon. And it may bring more in line to the question, okay, well, is it a time where serviceability buffers potentially get brought back into the equation? Because the serviceability buffer, right, which is currently sitting at 3%. For those who don't know what that is, if you're in 7%, just for example, because that makes it really easy, if it's at 7% and you got a 3% serviceability buffer, which we do right now, then the banks have to assess you at a 10% serviceability rate, right? So that's with the buffer, the interest rate, your interest rate plus a buffer applied together is 10% right now. During COVID, like when interest rates got down into the twos, it was still sitting at a 2% buffer. So hence why they bumped it up to the 3%. So then instead of rating you had a 2.5% interest rate with a 2% serviceability buffer, and they're assessing you at 4.5%, they bumped it so they're assessing you now at 5.5%. So that when they went through the big rate rising cycle, the big rate rise cycle, you weren't left with your pants down because you did a deal at 2.5%, and now within 2 years it's at 6.5%, 7%, or 6 to 7%. So they knew you could afford it from that front. Now that we're coming on a rate cutting cycle, depending on how much further it comes in, but obviously we're not going to be raising it anytime soon, it may come more into the consideration. I don't know how soon it will come in. That's governed by APRA. So again, a completely different body, Australian Prudential Regulating Authority. They look and assess things very differently. And their whole thing is about prudential lending, right? So being very careful with lending. So whether we see that come in or not will be interesting to see. But I think
which is a smart thing, right?
Of course.
Let's face it, because otherwise, look what happened in the US, right? So obviously back in...
Completely different. Completely different lending product.
Yeah, in terms of lending though, and predatory lending and not being prudent as what you said before, APRA has put it in to make sure people can afford, should there be.
The American lending product that brought America unstuck was the non-recourse loans. So you default on a loan, you go hand your keys back in. Like, that's what brought America unstuck. Plus, yes, not having prudent lending policies. But that's why I think Australian housing is so safe. Because for one, our LVR on the total housing market is actually extremely low because of so many people that own their properties outright at very low debt levels.
100%.
But then on top of that as well, we do have a very careful governing body on it, which I'm all for.
Yeah, great.
It keeps massive stability under the market.
Okay, so realistically, for people, how much extra borrowing would this actual cut change for people? Because people think cut, okay, now I can borrow a whole bunch more. Is it really that much?
Man, I think this goes back to your question before of like, should people be getting excited on the rest of it? You have to take into the equation a simple thing. Interest rates are up 4.25%, or they were up 4.25% from this time 3 years ago, right? 4.25%. So the base rate was 0.1. Then we went to 4.35%. Now we're just back by 0.25%, 25 basis points. Put that into equation. If you were to borrow $1 million worth of debt, that's $42,500 more in cost per $1 million worth of debt, just from an interest perspective, just interest, no principal, just interest on that $1 million worth of debt. An extra $42,000. I'd hate to be a blue chip investor at that point, right? Because you're already negative, and now for every $1 million you borrowed, you're another $42,000 and $42,500 negative. For a 25 basis point cut, 0.25%, it's $2,500. It's nothing. You know what I mean? On that $1 million worth. So it's a tiny variance in the scheme of things. And what I think it will boost sentiment. But in terms of serviceability, man, it is marginal. A $500,000 loan, it's a $1,250 difference.
Annually.
Yeah. So it's nothing. Okay. It's nothing. Right? On that $1 million worth of debt, it's $2,500. So it's actually a very, very small amount. I think what it will change is sentiment. It will make people, confident and realize and happy that when the rate interest, the hiking cycle is done and then we're at a stabilized or a cutting point. So I think that will improve sentiment. I think that's what's going to potentially have an impact on the market. But really, man, that's it. I don't think it's going to be too much more above and beyond that.
Okay, so are we expecting markets to pull back at all now that we know that interest rates have peaked and we are going to be in that cutting cycle? Or
are we expecting markets to pull back?
I'm not sure. I'm just asking you. Are we expecting a run? Or are we expecting them to pull back? Like, where are you seeing the market with this particular change?
Man, so definitely not a pullback. So I think, like, obviously it's going to give more people more confidence. That comes to sellers. So sellers who maybe really need to sell, if maybe they don't quite as much need to sell, they may be a little bit more hesitant to take a lower price point. People who are thinking about selling may hold off a little bit now of like, or maybe I'll hold on for a little bit longer and see what happens with the market. And then people who don't need to sell might just completely hold off and just go, oh, well, maybe it's going to boom again or whatever. So I think it will go towards creating a supply deficit again. Like it will have a negative impact on supply, which is good for growth. But I think like those markets that were like falling or stagnating, I think they're just going to like balance out and like probably like plateau out and chill because we might see a bit of, balance come back into that market. I think the big shift that we're going to see is in markets that were already either running and performing or starting their run. I think they're going to see some serious fire under the belly.
Okay. So it's just almost accelerating what was happening.
Yes. So I think it's like that. It's not even so much accelerating, like if we're talking about across the board, it's like that slight tweak up. So if it was going down, I think it will plateau. If it was plateauing, I think the plateau will just stay, but tighten. But I think markets that were increasing, I think they will get additional pressure.
Okay.
And the thing with that as well is you're going to get people who are FOMO. A lot of the markets that are doing really well right now are investment markets that make a lot of sense. I think they will get renewed and heaped on pressure from that perspective too. You look at the new markets that like you and I both went heavily into last year and like new markets, new locations that we've entered that we both picked up aggressively last year and into this year. Man, I think they're going to be the standout performers of this year. And I think the trajectory change is going to be because of what has happened. Like a slight trajectory change will come from sentiment change coming from interest rate cuts and what is expected to happen over this year as well.
Okay. You mentioned FOMO just before, and I want this to land for people because there's a few different audiences obviously listening to our podcast. There are people that have the ability to do something or are in the market and they're loving what you're saying. There are people that can't for whatever reason. So that FOMO, what would you say for those people that can't do anything right now? Like, Is there going to be opportunities down the track? Are they missing the window because everyone's starting to get excited now? Just a message for them, for that audience.
Man, nothing changes, right? So like if you've got the ability to get in at any point in time, you should be getting into the market. If you can't, you should be assessing why you can't. Now, if you can't because you don't have enough cash and you can't beg or borrow your way to getting yourself a deposit together to get in, then I would just be saying doing everything you can, as always, doing everything you can to scrape together your first deposit to get into the market. Because that's the most important thing. We get that first deposit together, we get that first deal done, first deal in the tank. That's what's going to move the needle and take them to the next level, right? And that's what we should really be pushing for, building a portfolio.
Yeah.
Now, if you're stuck because of something you hold existingly in the portfolio, as always, man, you have to look at the opportunity cost. What's the debt associated to it? What's the equity that's left in the deal? What could you sell, get out for, get the debt back, get the cash back, all these sorts of things. Man, if you're getting FOMO, I mean, regardless of whether you're getting FOMO or not, for me, man, I don't get FOMO. I look at a market, I make decisions based on a market. And based on my own portfolio. Do I think this is the right time to get in? Do I think this is the right time to get out? What should I be doing? What's my velocity of money doing for me right now? Yep. That's the most important thing. Man, no one should view anything any differently. You don't rush into something just because, like a FOMO side of things. You need to always assess everything properly, assess what's in the portfolio. Because, I mean, you may not be able to do anything else and you're stuck, but if the locations that you've bought in are still growing, then sometimes you just need to be patient. Because if they're still sending it and you got 20, 30% in the tank this year because of what you set up in your portfolio, that could be $100,000 plus, 150 grand plus just this year alone because of like per property. But you may be stuck. And if that's the case and you can't do anything else, but those locations are growing for you, then man, it's one of those things of like the patience will pay off in that piece if you have to do it. But I think this is where, man, you need to be super, super critical on yourself when you're assessing your properties in your portfolio. Are they going to perform like that this year? And if they're not, what is the opportunity cost of holding them versus selling, getting those things I stated before back and then going into a different market? I think they're really prudent things to have a look at and assess in your situation as to what's actually going to give you the best result.
Yeah, I love that. And I think you just touched on also long-term focus. I mean, people who think they're going to make their money. I mean, yes, there is an accelerated point of getting into the right markets at the right time. But if you do have that long-term focus, then you will never have that FOMO because you're always thinking a few steps ahead as to how it's going to impact you.
Yeah.
Right. I'm curious on your thoughts.
And you always should be though, right? You always should be from that perspective.
Yeah.
Like everything should be a strategic play.
Yeah.
Every time you look at your portfolio, every time you make a decision in your portfolio, every time you do anything in your portfolio or even assess your portfolio, it should always be from a strategic standpoint. Whether you're selling something, whether you're buying something, whether you're renting something, right? Like these days I can be more forgiving with my clients, with my tenants and like, you know, maybe I won't bump to full market rent every single time. And I don't. Typically, if I've got a good tenant there, man, and like I've got the ability to do a $100 a week increase or a $50 a week increase, I might, on a 50, I might bump it by 20 or 30 bucks if they're a really good tenant. If it's $100 a week, I might go up by 50 or 60 bucks. I'll still keep it sort of touching distance, but not jack it the whole way because I've got the ability to retain that really good tenant, which I want to do, but then also be able to bump my rents at that point. And then the following year, if the rents hold at that $100 extra and I just did 50 or 60, I can still bump it an extra 20 and I'm still not at market, but I'm still looking after them in that instance. But I mean, if you're starting out and you need the serviceability and you got 2 properties and you can go up by $100, don't do what I do. Go the full $100 because that's going to help your serviceability. If you can go, if there's a 50, don't go to 20 or 30, go the 50. If you're early in your portfolio and you need that serviceability, it's always with a pinch of salt with what I say with that, because like if you're going to burn a really good tenant and they're going to move out and then, all right, you might release it for the extra $50 instead of the extra 20 or 30, but you had to pay a relet fee and you had 2 weeks vacancy. You got to weigh all those things up. But like I will just automatically go in at that instance. Okay, sweet. I'd love to, it's great that I can go for the 50, but like offer them just do the 20 or 30 or whatever and keep them happy or whatever. Yeah, exactly. But if you're early in again, everything here is a strategic play in terms of your portfolio.
Yep.
In that instant, if you need that additional borrowing, if that's across 2, 3, 4 properties, that could be an extra $200-$300 a week, or it could be just an extra $100, $200, $300 a week, whatever it is. If you need that from a servicing perspective, right? So you have to treat it as a business.
Correct.
In that instance. For me, again, we go back to this. Yes, at some point I might, across all the properties, leave $1,000 on the table a week, maybe over the course of a year. But this being my business and looking after my tenants in that instance, how many of those may have turned over in that time frame of not looking after them or retaining that tenant at $20, $40, $50 a week less over, let's say, a $600 a week rental, but keeping them in there for 10 years or 5 or 10 years, my lack of turnover and my lack of headache with that, I actually would probably come out in front. But again, if I rewound all the way to the start, I'd be pushing the needle every single time.
Well, you did, right? When you started
100%.
out, you had to because you're on low income.
And I needed it.
You needed it, yeah.
And that's why it's assessing it relevant to you and your situation. And for anyone working with APS, I just suggest reaching out to, like I have clients reach out to me all the time about little things with little updates on tenancies or sale prices or all these different things. And we're always just assessing it. So like, okay, exactly what I ran through before. Great tenant. All right, maybe it's $20 a week less. Do you need the serviceability from that end? Well, it's a yes or a no. And then you make a strategic decision from there. And then once you do it with them once, they know how to assess it after that point anyway.
Yeah. Just talking of rents, do you see any impact in rents with changes of interest rates? Because I'm just thinking of what people will be thinking listening to this.
Yep.
What do you see any impacts, any changes?
Man. Yahoo Finance. I had a young journo ring me earlier this week to chat about this thing as well, because Jim Chalmers put out this thing after the RBA rate cut, and he's like, "Oh, landlords should be passing on the cut to their tenants." Like, are you fucking kidding, mate? Like,
is that what he said?
Oh, mate, he's a fucking idiot. You know what I mean? And like, what we have for every $1 million we borrow, our repayments went up by $42,500. We didn't put our rents up by $42,500 a year, $850 a week. We didn't put them up by that amount. We weren't able to, you know what I mean? And then to suggest that like we should cut it now by what? $1,200, bloody a $2,500 a year, like a $20 to $50 a week rate cut just because it passed on the cycles. Like, how many people have been just like holding on? And cost of living, like talk about cost of living pressures, let's say a multi-property portfolio, holding on because of it. And now that actually it's I can breathe now because I haven't been holding on to something, at that amount negative or whatever. Yeah. It's like to make that comment, man, it's just like it's a complete out of touch comment.
Well, it's a political comment.
And I was about to say, it's about to literally lead into it. Political comment of like trying to look like they're working after the people. But it just makes no sense because like it's got absolutely nothing to do with it. So to answer your question, man, I don't think it will impact it at all, and it shouldn't impact it at all.
Yeah,
because it doesn't affect it. If anything, man, you might get more home buyers now who are willing to go that slight bit to upgrade or whatever. They might start buying out over the next 12 months, especially if we see 3-4 rate cuts over the next 12 to 18 months. You might see home buyers starting to buy out the rental stock, further depleting rental stock, which will drive rents up even higher. So it's, if anything, man, like I think it's more likely that's going to happen than rents come down. I think more likely over the next 12 to 18 months, we might actually see a bit of a boost to rental prices in that time frame.
And just a little tip, just as a little side note for a lot of our investors out there, that when your property manager does come to you with a rent review, the path of least resistance, sometimes they'll just say, yep, let's just put it at this rate. Yeah. Or they'll ask you, what do you want? You should be pushing back on them and saying, well, give me some information. What's happening in the market? What advice would you have? Because that's really important. Yeah. If you've got a big portfolio and your property manager's a little bit lazy on that side.
I mean, property managers, like it's the hardest job in the property industry, in the real estate industry, paid the least.
And a big shout out to all the property managers out there doing an incredible
100%.
job.
And man, that's my exact point. They typically work pretty much the hardest. They deal with the most shit. They get paid the least. And a lot of the time they're the last person, if ever, to get thanked, right? So man, I think like what you have to realize is, and a lot of the time that's how they're treated by their bosses as well, right? So what you've got to realize is like they aren't incentivized to get you an extra $20 or $50 a week rent. So I would always ask them like, what do you think I could lease this for? And like, how would you justify what we could release this for right now? But always check like what's currently on the market, because they may go, oh, like I just re-rented one at $500 a week. Yours is pretty much the same as that. So, I think we could get this. And it's like, you could jump online and then have a look and like, there's nothing on market comparable sub $550, $600 a week. So it's like, well, hang on a sec. This is where the market's set. Let's say it's $600 a week. Like, let's say there's 2 on the market, or there's 10 on the market, 5 sitting around that $550 a week. That's at that point. And then, 5 sitting at the $600 a week at the slightly better point. Let's say yours is in the slightly better point. You would go, you know what? I've liked this tenant. Let's offer him the $580. It's a $600 a week rental. We'll offer him $580 and see where it comes back, and then go from there, man. But like, you've always got to proof it, because like, what property managers make for one isn't that much, but even what like a rent roll makes from that perspective in this dollar market that we're talking about, like $400, $500, $600 sort of rentals, it's not that much. So like, no one's overly incentivized to try and get you the best dollars. The person that's the most incentivized to get you the best rental money is you, because that's going to add to your serviceability. It's going to add to your bottom line. It's going to add to everything, right? So like, people have to still be active with this from a business perspective on it. And again, It's one of these things, like I completely understand a property manager not being overly motivated to do it, you know, from that perspective. And you got to look at it this business perspective. You're the one's going to benefit the most from this. You got to check each and every one. And even these days, like for full disclosure, like obviously got a 100+ property portfolio. I don't do this on every single one of my properties, but my assistant that manages it for me, every single time she brings me a release, she tells me what the property managers say they can get, and then what's currently sitting on market comparable in that suburb at that price point, all the rest of it. I get a ballpark. I can assess it within 30 seconds. Okay, this is what we want to go for.
Yeah.
And then make the decision from there. So even with my own portfolio, yes, I don't still properly like actually do that piece of it myself, but someone else that I employ obviously does that as well, because we treat it like a business.
Yeah, absolutely. All right. So we've spoken a lot. I mean, the topic is, should you buy now or wait? Is there any possible reason why you should be waiting?
If you've got the ability to buy, no. The only time that you wouldn't is if you actually couldn't afford to hold a property right now.
Okay. So servicing.
That's the only caveat, but that's the caveat that's always there, right? That's a caveat literally that's always there.
Yeah.
But man, outside of that, no. And it goes for all time. Like we could replay this potty in 10 years and the interest rates could be at 0% or they could be at 10%. If you've got the ability to buy right now, whether it's in wherever we are, February in 2025 or if it's February 2035.
Yep.
If you have the ability to buy right now, buy right now.
Okay.
It's as simple as that.
Question for you. What about just flipping it? If someone's looking to sell, I know we touched a little bit on selling before. What advice would you have for them?
In regards to
just in terms of this market, like we're talking about, should you buy or wait? If you're looking to sell in this current market, interest rates have just pulled back, just to flip the script a little bit, because there will be people looking to sell.
Yeah.
What advice would you have for them?
Mate, I think so advice in selling right now is pretty simple. It's if you don't need to sell now and it's not going to change the game for you selling. If you're in a running market that's still growing, I would hold on right now and time your exits, like have a look, because its serviceability is going to keep increasing, which is the ability to continue to borrow money and pay more for pricing, right? Both from investing and a buying and an owner-occupied point of view. So if a market's running right now, I would retain those properties in those markets and see how much further that they can go. If a market's stagnating right now, or it has been stagnating and it's holding you back from doing something else, then I would sell. I wouldn't make a decision purely to sell from one rate cut in the last 4.5 years with the unknown on how much until when we're going to see the next one as well, right? So I would be making the decision around that. Yeah, man, it always goes the same. You know, if you need to sell something, sell.
Yeah.
If you don't need to sell, don't sell. Sell when's the right time to exit. And that's what we always try and do. Like we try and build portfolios and strategize around not needing to sell, but selling when the time is right. Because that is what will make you the most money. Because so often when I look at it, man, when a market comes off from the peak, it doesn't matter if you're the bluest of the blue chip or if you're the shittest of the shit markets, right? When a market comes off the peak, it always will come back. So if you can run it as far as you absolutely can, and there's been some markets, I look at Perth, for example, man, there's been some markets that pull back 10%, some of them a little bit over 10% late last year, when a bit of a cohort of different sort of style of buyers pulled out of a market and that immediate heat went out of the marketplace. We saw roughly about a 10% drop back. But I own properties in that area and I don't believe that market's done yet. Affordability is still strong. We just had this blip. We've had this blip of like 3 to 6 months where this cohort exited, but it's the first home buyer market. So I'm extremely confident first home buyers are going to come back into that market. I believe by the end of the year, we're going to be at parity back to where we were like 6 months ago. And then I believe it will push past it as well. I don't think we're going to end up with the same money. I think it'll be further. And I don't have a need to sell those properties right now. So I'll hold on till the time's right to exit.
You did bring up a good point before about if you're holding onto a property to get a better price, but then you're going to be buying into the market or using that money down the track. If you sold it now, what could you do? What could you be doing right now?
Yes.
So the opportunity cost, you really got to think that through very carefully, right? Because you could think you're making a right decision, but you might be buying in a hot market by the time you're trying to sell in a hot market. So what advice, I mean, can you give advice around that? Is it just really assessing your portfolio or having a strategist to really pinpoint when is the right time to exit?
In terms of the market specifically? Yeah, I'd be having a chat to your strategist. So your strategist will give you a rundown of like how we're looking at things internally within the market and then make a decision off the back of that as well. If you tune into your School of Property webinars, I quite often will give my sort of take on different markets and locations at the time as well, and then make a call from that too. But man, it's always relevant to the individual, what you got in the portfolio, what makes the most sense of selling right now. And then, yeah, man, making the call from there. But I would definitely suggest speaking to your strategist about it to make those calls, make those decisions.
Mate, I think we've absolutely nailed it. It was a fast 30.
Mate, we did it.
Must be the Sydney air. I don't know. What do you reckon?
It's crisp, mate. It's cool. I think it's 30 degrees up in the GC with the sun out. It's 20 degrees in Chile down here. It's probably 10 degrees colder in Melbourne, but hey, mate.
At least. I think we nailed this particular topic, Sammy. I think it was nice and snappy. I think the listeners will get a lot of value out of it.
Yes.
Last take, actually, interest rate predictions. Did we touch on that earlier on? Where do you think they're going to stabilize for a little bit and then...
I think we may potentially see 2 more rate cuts this year, maybe one around mid-year, maybe one at the end of the year.
Okay.
It would not surprise me at all to only see one more cut maybe in the back half of the year, Q3, Q4 of this year. Man, I think they did it to test the market. They're going to see how it responds. They're not going to be cutting again anytime soon. And I think, the crazy thing is it's like trying to forecast an economy, 6, 9, 12 months away. There's a lot of things that could play out in that time frame as well. But they're trying to get inflation back into the target band. I don't reckon they will cut again until we are properly back into the target band. But it just depends, mate. Depends what happens, in the economy, in the market, labour market, all that sort of thing as well. Like Australian labour market's holding extremely firm. Our unemployment rate's sitting at like 4.2%, which is super tight in long-term trends.
Fundamentals will always prove right, Sammy. Isn't that right? You don't let interest rates dictate whether you should be doing things.
Man, interest rates movements are a bonus, right? Because at the end of the day, man, the overall game plan, it's not to hold property forever and carry this huge amount of debt into retirement. It's to get your portfolio down to a 0, 20, 30% LVR, these sorts of things. So like debt in the long term, it's just a cost of doing business and you want to get access to as much as possible. So, man, I would be gearing up. I'd be doing absolutely as much as I could right now to get as much out there in the marketplace as possible. You and I are very excited about certain locations that we've been buying heavily into for the last 6 to 12 months. We probably will continue to do so and obviously continue to do so for our clients as well. So, man, dude, there's always going to be places to make good money. Position yourself for that. If you can afford to do it, hold on and build that thing out and then, mate, just reap the benefits of it. And then over the long term, interest rates are going to be coming down anyway, right? Over the next 12, 24 months. You see interest rates coming back down and then a lot of clients starting to reduce and retire debt over the next 2, 3, 4 years as we get closer to 2030 with getting there's 500 plus investors on the stage. So, man, you want to be taking on as much as you can right now to ride these different waves of growth to then debt consolidate your cash flow deals as well by late 20s going into 2030. So,
mate, I think you nailed it.
Embrace it, dude. Get as much of it as you can.
A great way to finish off, Sammy boy.
Jimmy, mate. Thank you for joining me.
Finished on a very different tone to the way we started.
Yes.
A bit more calmer. A little bit. Which let's treat this as a therapy little session. We started really hot.
Fuck therapy, bro. No, mate, mate, it's fire in the belly, man. Like I just want to. The thing is, okay, like
we're joking about it. We are joking about it.
You know what'll be funny, mate? What I think will be funny is in 2030 we'll have 500 plus investors on the stage. I bet you any money in 2031 we still won't win Buyers Agency of the Year. We'll fucking do what no one else has done, or we still won't win it. It'll go to some fucking.
You might have to increase your marketing spend,
mate. Don't even get me started. Or how about I just completely decrease it, get rid of it, 0. What is my marketing spend?
We don't have any marketing spend.
There's nothing, mate. There's nothing.
Anyway, that was just a little side note to finish off and a little bit of a fizz. Anything you want to say before we go, Sammy boy?
Mate, thank you everyone for tuning in. I'm not going to go. I'm not going to bite, mate. I know you're dangling a big bit of bacon in front of me right now. Not your schnoz, but anyway.
Oh, let's wrap it up.
Jimmy, mate, thank you for coming in, joining me today. Listeners, thank you for tuning in once again to another Scouting Australia podcast. If you're enjoying the episode, as always, please send it on to someone else you think might take some great value out of today's episode. If you haven't left us a 5-star review yet, please jump on there. Leave us a 5-star review. We massively appreciate it. And if you haven't, hit the follow or subscribe button. Once again, guys, please jump on there, hit the follow, hit the subscribe button. We're pushing to build a community of people that are thinking, talking, and acting the way that we do about property. And until next week, guys, it's another Scouting Australia podcast.